Module 2 Stocks. Stocks. Stocks, also known as shares, or equity, is a type of financial instrument that represents a unit of ownership in a company, usually a corporation. When a company issues stock, it is essentially selling ownership in the company to investors in exchange for capital. The capital raised from the sale of stock can be used to finance the operations of the company or to fund new projects. There are two main types of stock: common stock and preferred stock. Common stock represents ownership in a company and typically entitles the shareholder to vote on important matters, such as the election of the board of directors and major business decisions. Common stockholders also have the potential to receive dividends, which are a portion of the company's profits distributed to shareholders. Preferred stock, on the other hand, does not typically come with voting rights but may entitle the shareholder to a fixed dividend payment, which is paid out before any dividends are paid to common stockholders. Preferred stockholders also may have a higher claim on the company's assets in the event of bankruptcy or liquidation. Stock prices are determined by the supply and demand for the company's shares in the market. If there is high demand for a company's stock, the price will increase, and if there is low demand, the price will decrease. Stocks can be bought and sold on stock exchanges, such as the New York Stock Exchange or the Nasdaq. Investors can buy and sell stocks through brokerage firms or online trading platforms. Overall, stocks can be a good investment option for those looking to participate in the growth and profits of a company. However, they do carry risks, as stock prices can fluctuate based on a variety of factors, including market conditions and company performance. It is important for investors to do their research and understand the risks before investing in stocks. Stock market. The stock market, also known as the equity market, is a system of financial markets where publicly traded companies can raise capital by issuing shares of their stock to investors. It is a platform for buying and selling stocks, bonds, and other financial instruments, where buyers and sellers come together to trade shares of publicly traded companies. The stock market serves as a critical component of the global economy, providing companies with access to capital and investors with an opportunity to participate in the growth and profits of publicly traded companies. By buying shares of stock, investors are effectively buying a piece of ownership in a company and can potentially benefit from increases in the company's stock price and any dividends paid out to shareholders. Primary market. The primary market is the financial market in which newly issued securities, such as stocks and bonds, are sold for the first time by the issuer to the public. In other words, the primary market is where companies raise capital by issuing new securities to investors. The main purpose of the primary market is to facilitate the issuance and sale of new securities, which provides companies with access to funding to finance their operations or growth. In the primary market, securities are sold through an underwriting process, in which investment banks or other financial institutions purchase the securities from the issuer and then sell them to investors. The price at which the securities are sold to investors is determined through an initial public offering, IPO, or other offering process, and the proceeds from the sale go directly to the issuer. Investors who participate in the primary market have the opportunity to purchase newly issued securities at the initial offering price, which can be lower than the market price once the securities begin trading publicly. However, investing in the primary market can be risky, as the issuer may be relatively unknown and untested in the public markets. Once the securities are sold in the primary market, they begin trading in the secondary market, where investors buy and sell previously issued securities among themselves rather than buying them directly from the issuer. The secondary market provides liquidity for investors who wish to sell their securities and allows new investors to buy them on the open market. For example, on August 19, 2004, Google's IPO offered 19,605,052 shares at $85 per share, sold in an online auction to make the shares more widely available. This online auction is known as the primary market. Market opinions. The market's opinion on a company's assets refers to how investors and analysts perceive the value of their assets and how they factor that perception into their decisions to buy, hold, or sell the company's stock. Assets are a vital component of a company's balance sheet, and their value can significantly impact the company's financial performance and stock price. Investors and analysts use various methods to evaluate the value of a company's assets, such as its property, equipment, inventory, and intellectual property. Some standard methods include comparing the value of the company's assets to its liabilities, i.e., its book value, using discounted cash flow models to estimate future cash flows from the assets, and comparing the company's asset values to those of its competitors or industry benchmarks. Suppose the market perceives that a company's assets are undervalued. In that case, investors may view the company's stock as a good investment opportunity, driving up demand and causing the stock price to rise. Conversely, if the market perceives that a company's assets are overvalued or that its asset quality is declining, investors may sell their shares, causing the stock price to decline. The market's opinion on a company's assets can change rapidly based on new information or changes in market conditions. Hence, investors and analysts need to stay informed about the company's financial performance, industry trends, and other factors that can impact the value of its assets. Debt-equity ratio. The debt-to-equity, or D/E, ratio is a financial ratio that compares the debt a company has to its shareholders' equity. The ratio is calculated by dividing the company's total liabilities by its shareholders' equity. The debt-to-equity ratio measures a company's financial leverage or the extent to which it relies on debt financing compared to equity financing. A higher D/E ratio indicates that a company relies more heavily on debt to finance its operations. A lower D/E ratio indicates that a company relies more on equity financing. The D/E ratio is important because it can provide insights into a company's financial health and risk level. A high D/E ratio may indicate that a company is taking on significant financial risk, as high debt levels can increase interest expenses and decrease cash flows. On the other hand, a low D/E ratio may suggest that a company is financially stable and can invest in growth opportunities. However, it is essential to note that the optimal ratio can vary depending on the industry and the company's specific circumstances. For example, some industries, such as utilities, may have higher levels of debt due to the capital-intensive nature of their operations. Additionally, a company with stable cash flows and a solid ability to repay debt can handle a higher ratio than a company with less predictable cash flows. Investors and analysts often use the debt-to-equity ratio to evaluate a company's financial health and risk level and to compare its leverage to its peers or industry benchmarks. However, it should be used with other financial ratios and metrics to comprehensively understand the company's financial performance and risk profile. To calculate the market debt-equity ratio, we need to divide the market value of the company's debt by the market value of its equity. The market value of debt equals total debt. The market value of equity equals number of shares outstanding x market price per share. Assume a company has a market value of debt equal to $140 million and a market value of equity equal to 26 million times $4, which is $104 million. Therefore, we need to divide $140 million by $104 million. The market debt-to-equity ratio is 1.35. Operating expenses. Operating expenses are the costs that a company incurs in the day-to-day operations of its business. These expenses are necessary to maintain and grow the company's operations, including salaries and wages, rent, utilities, office supplies, marketing expenses, and insurance premiums. Operating expenses are typically recurring and are incurred regularly. They are separate from capital expenditures, which are investments in long-term assets such as property, plant, and equipment and are recorded as assets on the balance sheet. Examples of operating expenses include salaries and wages, the cost of compensating employees for their services, including payroll taxes and benefits. Rent and utilities, the cost of leasing or renting office space, as well as the cost of utilities such as electricity, water, and internet. Office supplies and equipment, the cost of purchasing or leasing equipment and supplies needed to run the business, such as computers, software, and furniture. Marketing and advertising expenses, the cost of promoting the company's products or services, including advertising, public relations, and market research. Insurance premiums, the cost of protecting the company's assets and liabilities through insurance policies, such as property and liability insurance. Operating expenses are essential to monitoring because they impact a company's profitability and cash flow. By controlling operating expenses, a company can increase its profitability and free up resources to invest in growth opportunities.